Ladies and gentlemen, dear IFA friends, good morning, good afternoon, good evening, maybe even good night. Welcome into the virtual room of the IFA OECD seminar. Before giving the screen to Robert Danon, chair of the PEC, who will go into the topics of that seminar, I want to inform you on the poster sessions that will be starting immediately after this seminar, about 5 p.m. until 5:30. Now, wishing you an interesting IFA OECD seminar, I give the screen to Robert Danon.
Yes, dear IFA friends, welcome to today's session, IFA OECD. This is, of course, one of the signature sessions of I should say, the Congress, but this year, the virtual Congress. It's not a mystery what the focus of this session will be. It's going to be on digital. It's going to be on the two pillars, but you will see that the discussion will go a bit broader than that. It will not just be about the technicalities of the two pillars. The panel will be looking at broader implication, in particular the current landscape. What is the impact of the US election? How will the project go forward in light of the new landscape and the recent development? To chair this session, we're very fortunate to have Stefan Wegel, who is a professor of international tax law at the University of Amsterdam, a partner at the PwC, where he also serves as the global policy leader. So without any delay, I will turn to Steph for an introduction of the panel, the focus of the session, which I've already alluded to, and with no doubt, I'm sure that it will be a very inspiring and interesting session. So Steph, the floor is yours.
Thank you very much, Robert. Hello, everyone, wherever you are in the world. What an incredible difference. Last year, when we were having this IFA OECD seminar, I think we had a full house in London with so many people really at the top of their attention and their toes to hear from our panel. So this year we'll do it virtually, but I think content-wise, we will have a lot on offer today. Before I focus on the content, I'll introduce the panel to you. We have an unusually large panel. We have 10 panelists. You see them on the slide here. So we have Pascal Saint-Amand, who you all know is the director of the Center for Tax Policy and Administration at the OECD in Paris. We have Grace Perez-Navarro, the deputy director at the same center. Achim Pross, head of the International Cooperation and Tax Administration Division, also at the OECD. Then we have Barbara Engels, who is Global Tax Policy Leader at EY. Rashmi Das, who is the IRS Joint Secretary at the Indian Ministry of Finance. We have Gaël Perrault, who is Director of European and International Taxation of the French Ministry of Economy and Finance. We have Liz Chin, who is the Vice President of Global Tax and Chief Tax Counsel at Ripple Labs. Martin Kayenbaum, the Chair of the Committee on Fiscal Affairs at the OECD. Mike Williams, Director of Business and International Tax at Her Majesty's Treasury. On your program was Fabrizia Lapecorella, but Fabrizia had urgent matters to attend, but Marco Luvinale, who is the Director of European and International Tax Affairs at the Italian Ministry of Finance, and also very important in today's context, the Chair of Working Party 11 at the OECD, was kind enough to step in at the last moment. Finally, I've been introduced to you, but Risa Nuku, who is with Freshfields in Amsterdam, is for the third year in a row the secretary of our panel. Risa and I are here in the studio, the IFA studio in Rotterdam, where you saw a moment ago Hans Kogels as well. The other panelists are at different places in the world, and technology permitting, we'll have a very meaningful panel. Before I introduce to you the panel and the topics, I thought I'd just do a little overview. So this IFA OECD seminar in the past has been focusing a lot on treaty developments, but over the last few years, as you will have noticed, we moved more and more into policy. And you will remember that my predecessor, Wolfgang Schön, at the IFA Congress in Rio, addressed the, I think, 10 questions about digital. That, I think, was the kickoff, really, of digital in this seminar. I remember very well, and Pascal will remember this very well as well, that we had the seminar in Seoul, where just the US tax reform had been kicked off and was such an important driver of also the digital project at the OECD. And I remember that I was pushing Pascal a little bit and said, the international tax system is in a state of crisis. And Pascal will remember that he agreed and also expressed that he was agnostic as to where we go, agnostic as to ALP, arm's length principle, or something else. And then, of course, the year after, last year in London, we were days before the OECD would release the unified approach. Fast forward, here we are today in 2020. We now have two blueprints in front of us. We know what the content of those blueprints are. And today's session, apart from the first 15 or 20 minutes or so, will focus completely on Pillar 1 and Pillar 2. For both pillars, we'll do a 10 to 15 minute introduction, reciting the structure of both pillars. And then we'll have a hopefully lively discussion from all the members of the panel. Before we go there, Pascal and I will spend 15 minutes focusing really on the non-digital items on the OECD agenda. And Pascal, I think it's not possible to have an IFA OECD seminar without talking about COVID-19 and tax policy following COVID-19. Would that be a good place to start and ask you where the OECD is on COVID-19 and tax policy?
Sure. Yes, thanks, Steph, and hello to everyone, and thanks a lot to the delegates and other business representatives joining the panel today. And yes, sweet memories that you refer to, Rio and Copacabana, Seoul, and the Young IFA party, which was pretty wild, London, and a pretty great conference there, and COVID now and confinement. So where do we start the conversation on COVID and tax policy work? We start a confined conversation because we are all stuck in our homes when we cannot go to the office, but that's the case of so many others. So big frustration. In spite of through pride at the OECD, not only to advance the work on digital, and we'll go back to that at length, but to address the immediate challenges of COVID. I see at least three or four of them. One is the tax policy challenge. And you know, at the Center for Tax Policy and Administration, but also the Committee on Fiscal Affairs, there is a work stream related to revenue statistics and also to tax policy. And the first thing the G20 did actually after the first lockdown in March and April was to ask for a report on tax policy at the time of COVID, which we delivered in April. We have collected all the measures taken by governments to respond to the crisis, and we're still collecting these measures, so you can find them on our website. I stopped counting them, but we have probably hundreds of different measures listed there. And we did a report which basically tried to identify the best practices, what was working, with one main message, which was, if you want to face the situation do whatever it takes, right? And use the tax instrument to provide exemption to keep the capacities of production intact. So be generous in the tax exemption, be generous in the tax credit, whatever it takes. Recognizing that in a second phase, when the activity resumes a bit, you may need to be more targeted to limit the cost of the measures. But the main message still is don't rush to fiscal consolidation. Don't use taxes to reduce the fiscal deficit, because that may just kill growth, which is what is needed to pay the debt back. And don't duplicate the mistake you made in the aftermath of the global financial crisis of 2008. So that's been the main message. Now we're trying to refine a bit and trying to see how tax could be used, but we're still on don't rush to fiscal consolidation and don't use the tax instrument. And we'll update this work with the support of Working Party 2 and the tax policy delegates in the CFO. The second thing we did on the response to COVID was to try to clarify the impact of the crisis on the implementation of tax treaties, in particular as regards the definition of residents and frontier workers, and so exceptional circumstances. We tried to check whether the commentary of the Model Tax Convention would allow us to bring clarity, and there was a request from business, there was a request from tax administration, and we were able in a few weeks to come up with some recommendations which basically said the current Model Tax Convention and commentary should allow you to consider that there should be no impact, or the fact that if people are stuck in a country which is not usually their country of residence, also for the sake of computing some of the timelines which are included in tax treaties, you should be fine. You can suspend these to limit the impact. Finally, and we're still on that. By the way, on the tax treaty, at some point we may need to revisit this. We're at the second lockdown. I hope there will be no third wave of lockdown. And if we look at the promises of the vaccine, maybe we can be more optimistic than we were a few weeks ago. But we may need to update the work on tax treaties. For sure, we still need to complete the work on transfer pricing. That was one of the questions we received from businesses to say, how can I deal with some of the challenges of COVID in my transfer pricing policy? How will you deal with government subsidies? How do I do with the losses when I have low risk distributors and so? And we are working right now with Working Party 6 on providing further clarity on the rules. We're rushing. We aim to release these publicly, and that will be a Working Party 6 document. The first one on tax treaty I referred to was a secretariat document, because things were clear enough for the secretariat to give some indication. While on transfer pricing, it's really an intergovernmental process which is needed, and that's why Working Party 6 is involved. We're confident we'll be able to come out with rules by year end. That was a strong request from business. That may prevent us from doing public consultation, but we cannot have everything. We would have loved to have the public consultation, but this would have brought us beyond the year end. And we understood from business they needed the clarification before year end to feel the return. So that's been the environment we've been working on, and the specific work related to COVID.
Thanks, Pascal. I should say that personally, I have been absolutely amazed to see how quick tax administrations in the world got on their feet to address COVID-19. I have a sense that cooperation between tax administrations, in the sense that they connected to each other, learned from each other, and clearly your work on COVID-19 has been greatly instrumental in that, has been good for the tax administrations. Now, if I build the bridge for a moment.
Sorry, Steph. You give justice to another work stream that I should have mentioned. So you mentioned tax administration. We did a lot also with tax administration to support the work of tax administration, and that was done through the Forum on Tax Administration. I was thinking tax policy, so I forgot to mention that. But the team has done, I think, a great job with the support of the FTA on tax administration at the time of COVID. So thanks a lot for pointing to this.
No, so that actually is a bridge to other parts of the OECD agenda, and one is under the heading of the next frontiers in tax, and one of them is shaping tax administration 3.0. I wonder whether you could share with us a little bit what's happening in the digital transformation of tax administrations.
This is one area where we think we have very big challenges for the 10 years to come. We've given that title Administration 3.0, just to mean that, I mean, you had a paper-based administration, that's the 19th and 20th century for most part. Then we moved to the e-administration, where you incorporate some e-services and so more or less shy, depending on countries. We think now that tax administrations around the world are ready for, I mean, big jump there towards a completely new model. And that's why what we're trying to call with that name. There will be a meeting of the Forum on Tax Administration in December. You know, the FTA gathers the tax commissioners of more than 50 countries, mainly OECD and G20, but also a number of developing countries. Kenya, for instance, is one of the members. It's a very senior group with the tax commissioners themselves being involved. And we think that they have their own priorities, and international tax has some aspect, but one of them is how they can benchmark and how they can share the best practices. And shaping tax administration 3.0 may be an extremely pragmatic way for the FTA to deliver change, to deliver support to developing countries, which may move from the first paper-based model to a completely digitalized environment. So that's hard work ahead of us with systemic changes, including through I mean, the IT, it goes actually beyond the IT there. There are some models, and I think I can mention Russia as an administration which has completely changed its approach, which is based on the collection of data that may not be compatible with European protection of data, but it's an extremely interesting model. So successful that the tax commissioner of Russia was so successful that he's now prime minister, which may give idea to a number of tax commissioners across the world. So I would like to say hello to Mireille Mishustin, who was the brain behind the 3.0 tax administration in Russia. But beyond the joke, there is a lot to do there for tax administration, in particular in developing countries where all taxpayers now, almost all people are equipped with smartphones, and so which could help fight the informal economy, for instance. So new instruments, maybe to have game-changing approaches to old issues.
I think that's a very interesting point for the audience. Of course, the OECD tells us, and Pascal just told us, governments be careful going forward when you're trying to refill the government coffers, because if you raise taxes, you may kill the recovery. But to me, in the longer term, the digitalization of the tax administrations has huge potential to reduce the tax gap. I remember I was watching a presentation by one of the gentlemen who helped create the Russian digitized tax administration. And there was one graph that will stick with me for quite a while. That was while GDP over a number of years was flat, after the digitalization and real-time tax administration, revenue really took off. It was just amazing what happened there. And if you think that the tax gap, varies between, 1 point something percent to as high as, 13, 14% of GDP, this brings a lot of potential going forward, I guess. Moving to perhaps the last topic, Pascal, that we could address here before we move to digital. There is quite a focus on tax and development work at the OECD, and that includes capacity building, MLI, assisting developing countries with their tax treaty network and tax treaty administration. Is there anything that you'd like to convey to the IFA audience, particularly on this program?
Yes, absolutely. I mean, very quickly, we skipped the slide, and fair enough because we're short of time, but tax certainty is definitely a very important work stream of the OECD with very practical approach. ICAP, it's low profile, but it's real, and it's a way to get tax administrations to work together. And sometimes tax administration people are a bit less confrontational than treasury people who fight for the principles on the real cases. Sometimes it's easier to move forward, and the ICAP, I think, with the involvement of business is extremely interesting. Now, on tax and development, I think the main message is development aspects are key. We cannot build a modern international tax system without taking into account a majority of countries in the world, even though it's in terms of GDP a minority, but we need to take this into account. It's largely about capacity building, and there we have the platform for collaboration on tax with the UN, the IMF, the World Bank. Domestic resource mobilization is a key priority and consensual among all countries, all nations in the world. We need to rely more on domestic resource mobilization, and at the OECD, we do a lot on that sense, not only by the inclusion of developing countries in the inclusive framework, which sometimes is a bit frustrating because they're new, they may not have the capacity, and we need to build this so that beyond the equal footing in theory, we have equal footing in reality. But there are many things which can be done in practice, building the capacities, helping the tax administrations develop their transfer pricing expertise. We have this initiative, Corinne, with the UNDP on tax inspectors without borders, which is very practical, which has the support of business. By the way, BIAC is very supportive of it. It's working pretty well. I mean, for a cost of 5 to 6 million euros, we've already collected more than 500 million euros of taxes, and there have been the notification of more than 1.3 or 4 billion euros. So that's something which works, which is practical, and which may be a game changer. Inclusivity is not only, a slogan, a motto, but must be transformational in the work we do. So that was the message.
Yeah, no, an important message. It's easy to forget with all the focus on digital that there is so much other work going on and so many challenges that have to be addressed. So unless there is something on this part, Pascal, that you really wanted to bring across, I thought we could move over to the digital timeline, maybe impact assessment. And from there, I guess Grace would take over from you and address Pillar 1.
Absolutely. So we can move it. I will be quick because I'm pretty sure that among the participants, there are only a handful who do not know about that, because it's been the highlight of the work we've been doing collectively with business, with governments, with politicians, with the G20, with the G whatever, 7 and other G. So very quickly, timeline. We have delivered for the G20 finance ministers and the G20 leaders who met over the weekend and who issued a communique which recognizes the work which has been done and which extends the deadline to deliver a consensus-based solution by mid-21. So what we've done on the 12th of October is to launch a public consultation. We'll have until the 14th of December to get the feedback from stakeholders. We'll debrief over Christmas. It's a confined Christmas, so we had something to do. And early January, we'll have public consultation meeting, 14th, 15th of January. I think this is a scoop. That's the first time we release that information publicly. So please note in your calendar that you will have to be at your desk in your home on Zoom on the 14th and 15th of January for the public consultation. There will be no physical meeting, and then it's a bit unclear what the steps will be. We expect the task force in the digital economy to meet. We expect the steering group of the inclusive framework to meet. We'll have a meeting of the inclusive framework at the end of January, which will be debriefed on the public consultation, and then we'll prepare a calendar a work plan, if you want, to make sure that we can deliver something like an agreement by mid-21. The reason why there is some uncertainty is because we don't exactly know when we will have an interlocutor in the US. It takes always some time in the US after the smooth transition on the 20th of January to have people confirmed in the positions, including for the CFA delegates. Next slide.
Before we go to the next slide, Pascal, any surprises? Because the other day we had the G20 Leader Summit. Any news relative to the finance minister meeting a while ago?
No surprise. I think that the G20 leaders just took note of what their finance ministers told them, which is good progress. We have blueprints which are a solid foundation for a future agreement, and we need to redouble our efforts to reach this consensus base by mid-21. The leaders just rubber stamped what the finance minister said. So no surprise at all. And you know, I said when presenting the blueprints that the glass was half full or half empty. It's still the case. It's half empty because we didn't deliver and will not deliver by year-end. That's clear. But it's half full because one, we have a solid foundation for an agreement, and two, we have appetite for reaching a solution, but we have uncertainty. So that's where we are. A few words on the impact assessment, because we won't go back to them. I mean, Grace will do pillar 1, Arin will do pillar 2, and we thought it would be easier to have the overall perspective on the impact assessment. We did an extremely detailed impact assessment, and I would like to congratulate the teams, David Bradbury's team and OSA's teams at ECHO, which is the other directorate. We joined forces and we did a pretty detailed impact assessment. So the first takeaway from the impact assessment is we're talking about significant money overall. If you combine 1 and 2, it's an increase, a net increase of revenue between 50 and 80 billion US dollars per year, which is significant. If you add guilty, I mean, guilty is done, so I'm not sure we should include it, but we are roughly at 100 billion dollars, which is 4% of total corporate income tax. One could say not much, but some could say, well, given that impact, it means that you may have some countries losing, some countries winning, and therefore you need an incremental approach. But the other big takeaway from the impact assessment, and we had a dynamic model to do this, is to say that absent a solution, we are going to face serious trade tensions, which will have a negative impact on growth, or which will increase the recession. Let's hope that 21 will be back on growth, but we may lower growth by 1% if we don't have an agreement. And this is a pretty serious modeling based on the sanctions announced so far. And I'm not sure that the changes in the US will really mean big changes in the trade tension. So the impact could be 1% of growth lost because of no agreement. Finally, I think that we could agree, hopefully, that the COVID crisis justifies even more so the necessity of an agreement. Why? Because on pillar one, the digitalization of the economy was visible in the streets. The retailers shut down and Amazon delivery ringing your door, including mine. So you could see that something was happening, and countries need to address these. And two, on pillar two, because I think for many countries which have nationalized wages, it's going to be difficult to tolerate that their companies, when profits are back, that their companies can locate these profits in low tax jurisdictions. So I think there is a strong logic for pillar two. So that's what came out of the impact assessment. I can skip the next slides or go through them very quickly because I've been long. Next slide, please. You can see the estimated effect on GDP. This is what I indicated to you with a negative impact, which could go even beyond 1%. Next slide. The next step I indicated, public consultation. That's key. That's extremely important. We know that the blueprints are complex. I mean, tax is complex. I never buy those saying, oh, we need to have a simple tax system. We don't have simple tax systems. Simple tax systems are awful tax system. They're extremely unfair tax system. We're among tax people, we can say that tax is complex. But between being complex and over complex, you have a gap. We may be over complex, and that may be also because the blueprint was negotiated, but on Zoom without, I mean, a leadership at some point from some countries. And therefore, we just added layers and nobody ever compromised on anything, which means that sometimes when you read blueprint one, you say, what's agreed? Not much, but actually, yes, the overall architecture is agreed. We may simplify it further. Public consultation is an opportunity to get there. That's why we need to do further work on specific technical issues. We have in mind, in particular, the business line segmentation, which is kind of a nightmare on amount A, or the elimination of double taxation, which is both political and technical. We need to get it right technically. We need to get it right politically so that it's the right countries which will surrender the tax. And we need to move towards an agreement. Hopefully the vaccine may be helping us if we can resume physical meeting and if we have a new dynamic with the US with the new delegation. Not that the previous one, Chip Harter, who was the delegate, was just fantastic, really good and really committed. But at some point, the political leadership was a bit missing, especially getting close to the election. So having a new dynamic there may be promising of reaching an agreement on both pillars. And now I turn to Grace for pillar one.
Yeah, thanks for that, Pascal. I'm sure that Barbara will fill us in when we progress during the panel. But first, Grace, and just to remind our audience, the idea is that, of course, we'll not go into the details of Pillar 1 or try to expand, because that would take way too long. But Grace will try in a 10-minute elevator pitch to set forth the structure of Pillar 1, and then we'll address these technical and political questions and difficulties, challenges that Pascal just addressed. So, Grace, I just hand over that impossible task to you and wish you good luck.
Yes, thank you very much, Steph. Normally I can do this either in like 5 minutes or an hour, but 10 minutes is a bit tough. But anyway, we'll see how we go. As Pascal said, probably most people are fairly familiar with this, given that we've been talking about this for quite some time. So just a quick recap for those who were asleep for the last year. The Pillar 1 proposal brings together 3 previously competing proposals that had been proposed within the inclusive framework by members. We had the user participation from the UK, marketing intangibles from the US, significant economic presence submitted by the G24 countries. The idea here is in the pillar 1 is to take the commonalities of these proposals with the aim of trying to develop a consensus-based sustainable international tax framework that is reflective of the digitalization of the economy, but in a way that achieves a fair and more efficient allocation of taxing rights. It creates a new taxing rate for market user jurisdictions that is not constrained by physical presence, is based on the concept of net taxation of income, and seeks to avoid double taxation and be as simple and administrable as possible, noting Pascal's comments that tax systems are not terribly simple. Where we have a nexus established on the basis of the pillar 1, a portion of residual profit of in-scope businesses, which have yet to be defined, or agreed, I should say, we've defined them, would be allocated to market user jurisdictions using a formulaic approach. This is the amount A. It also features improved tax certainty processes, in particular, given that the solution involves an allocation of an M&E group's profits across multiple jurisdictions. So we need to have tax certainty to address that, as it cannot be addressed effectively bilaterally. And importantly, as part of the overall agreement, unilateral measures would have to be removed. The technical work is very advanced, as you can see from the detailed blueprint, although technical issues remain. There are key political decisions, as Pascal alluded to, that remain, notably the scope, the quantum, and the extent of tax certainty. And we really think that if we can get the scope agreed, that we will then be able to move ahead with resolving the other issues. So if we go to the next slide, we'll see the main components of the pillar 1. We have 3 key components: amount A, amount B, and tax certainty. And then within that, we have 11 building blocks. This is the overall architecture, and it's remained essentially the same since we first proposed the unified approach in 2019. I won't be able to discuss all of the components, but I'll try to get through some of the key elements as Steph suggested. So if we go to the next slide, we have the key element of scope and nexus. In terms of scope, as I said, this is the big unresolved political question. Within that, there are 2 main elements: the business activities to be included and also the size of M&Es to be included. The inclusive framework has tried to bridge the gap between those who want to focus the new taxing rate on a narrow group of digital business models and those who want to cover a wider set of activities. We've identified 2 categories of business activities: the automated digital services and the consumer-facing businesses. But to date, there's no political agreement on that. And as you know, last December, the US proposed implementing the new taxing rate on a safe harbor basis, and that also remains undecided. As I think everyone knows, that was not a terribly popular idea. In terms of the size of businesses in scope, this is to be determined on the basis of a revenue threshold based on an annual consolidated group revenue coupled with a de minimis foreign in-scope revenue carve-out. One option here is to implement these thresholds on a phased basis, starting with higher thresholds that could be gradually reduced over time or be applied for a longer period, and then only start the reductions after a post-implementation review has been undertaken. Other approaches could also be explored, including the option of a threshold based on in-scope revenues. No decision has been taken yet on the number of revenue thresholds or the amount of these thresholds or the use of a phased approach. Now, in terms of nexus, you all know historically this has been determined through physical presence. Here, the measure is based on a revenue threshold. There is a question of whether we should have different thresholds for ADS or CFB. There's also a question of whether there should be plus factors for determining nexus for consumer-facing businesses that would indicate a significant and sustained engagement within the market. Depending on where threshold amounts are set, consideration will be given to using a lower Nexus threshold for smaller developing economies with a GDP below a certain level, while also considering compliance simplifications. So now if we go to the next slide, we'll talk about the revenue sourcing and tax base. These are key issues. The revenue sourcing rules determine the revenue that would be treated as deriving from a particular market jurisdiction. These rules are relevant for applying the scope, the Nexus rules, the amount A formula. They are reflective of the specificities of ADS and CFB, and more broadly are designed to balance the need for accuracy with compliance costs. We've tried to achieve this through sourcing principles supported by a range of specific indicators subject to a defined hierarchy, and this approach tries to recognize the different ways that M&Es currently collect information in the context of their business model while still providing certainty to M&Es and tax administrations that the defined set of indicators can be relied upon to provide acceptable outcomes. Open issues here on ADS include cloud computing, and for CFB, the third-party distributors and franchise and licensing agreements. In terms of tax-based determination, here the idea is to use adjusted profit before tax measured as determined on the basis of consolidated financial accounts with some limited adjustments. One major issue here is what Pascal mentioned, the whole issue of segmentation on a business line or regional segmentation. The main reason for computing the amount A tax base on a segmented basis is because amount A will apply only to the profits that groups derive from carrying on in-scope activities. And so for a group that provides both in-scope and out-of-scope services, there needs to be a way to enable it to apply amount A only to the profits derived from in-scope activities. But this adds complexity, and a balance needs to be struck between accuracy and complexity and administrability. Another issue here is accounting for losses, including the treatment of pre-regime losses. Unlike profits, losses generated over a given period will not be allocated to the market through a formula. Amount A losses will be preserved and pooled in a single account at the level of the group and or segment where that's relevant, and carried forward to subsequent years through an earn-out mechanism. Further work is required to assess the possibility of including time restrictions on this and to develop rules for business reorgs. There's also the issue of profit shortfalls. Some members consider that where the amount of A profit of a group or segment in a given period falls below the agreed profitability threshold of the amount A formula, the amount A carry forward regime should treat the difference between this profit and the level of profitability threshold as a loss that can be carried forward to the next taxable period to improve neutrality by ensuring that amount A does not apply differently to taxpayers with volatile profits from one period to the next. Others in the inclusive framework don't agree, so this remains an open issue. Now, if we move to the next slide to talk about profit allocation and elimination of double taxation, profit allocation will be delivered through a formula, as I said, that is not based on the arm's length principle. And this formula will apply to the tax base of a group or a segment where relevant, and involves three distinct components. A profitability threshold to isolate the residual profit potentially subject to reallocation. To avoid complexity, this threshold would be based on a profit before tax to revenue ratio. Then there's a reallocation percentage to identify an appropriate share of residual profit that can be allocated to the market jurisdiction. And then an allocation key to distribute the allocable tax base amongst the eligible market jurisdictions. That is, those jurisdictions where a nexus has been established in accordance with amount A. So here we have several open issues: setting the threshold level and percentage, deciding whether there should be differentiation mechanisms for automated digital services, and how to avoid double counting. Now, if we turn to elimination of double taxation, here, this is a very important issue. Again, I think Pascal mentioned this. Here we have two issues: the identification of the paying entities and the methods to relieve double taxation. We are still working on these issues and look forward to input on that, in particular, to see how we can simplify the approach. Now, if we move to the next slide, we'll be leaving amount A, to go to amount B, tax certainty and implementation and administration. Amount B is not really related to digital, but it's an attempt to provide some simplification and greater certainty. It provides fixed margins for baseline marketing and distribution functions. There are different levels of enthusiasm for Amount B within the inclusive framework, but this could bring greater certainty and simplify transfer pricing administration, in particular for countries with limited capacity on issues where there are frequently disputes. We're still considering whether to have a narrow or a broad scope, and we're also considering a pilot to see how this would work in practice. Then if we look at tax certainty with respect to Amount A, it would be impractical, in fact, probably impossible to allow all affected tax administrations to assess and audit an M&E's calculation and allocation of Amount A, and to address potential disputes through existing bilateral dispute resolution mechanisms. That's why the blueprint contains a mandatory binding dispute prevention process that would provide early certainty before tax adjustments are made to prevent disputes related to all aspects of Amount A. So such disputes could concern, for example, the delineation of business lines, allocation of central costs, and tax losses to business lines, the existence of a nexus in a particular jurisdiction, or the identification of the relieving jurisdiction for purposes of eliminating double taxation. The process described in the blueprint remains under discussion and may be revised as work continues. The process is based on a representative panel mechanism that would involve both a review panel and, where necessary, a determination panel to ensure that early certainty can be achieved. This is a voluntary early determination mechanism for M&Es, where an M&E does not elect into the early certainty process and disputes arise. The new approach also provides for enhanced dispute resolution. There are different views on the scope of application of a new mandatory and binding dispute resolution mechanism beyond Amount A, and the blueprint sets out some ideas to bridge these different views. So further work needs to be done on that. And then if we go to implementation and administration, the implementation will require domestic law changes, public international law. Here we're working on a multilateral instrument, and guidance to supplement both domestic law and international law. So some important work there. As I said earlier, we will need to ensure the removal of relevant unilateral actions. We haven't yet identified what are the relevant unilateral actions or the process, but presumably it should be relatively easy for countries to get rid of their unilateral measures. So I think, is that my last slide?
I think so, Grace.
Yes, I think that's my last slide. So let me turn it back to Steph. Thanks.
Yeah, that was no small accomplishment, Grace. And for those in the audience that didn't join us right from the beginning, you may think that you just dial into an OECD webcast rather than the IFA OECD seminar, because you only saw, apart from myself, Pascal and Grace, but we do have a panel. So let's turn to the panel with a couple of questions, really. We'll talk about scope, because that's, when Grace, when we hear you talk about scope, there are some problems, but in a way, it comes across as fairly simple, but of course there are many problems with and challenges with Scope, both of a technical nature and of a political nature. Then the second theme we'll talk about is simplification. And then the third is more political in nature, I would say. What are the prospects if we have success or failure of the project? So let's start with scope. And of course, when we talk about scope, going back to the very beginning, probably only digital and what we would now call ADS, Automated Digital Services, was thought of as scope. Then we have consumer-facing business, and where do we go from there, or do we go back? So I thought that perhaps I could ask Gail to kick off the discussion on scope and identify the challenges from your perspective, Gail.
Thank you, and good afternoon to everyone. It's a pleasure to be with you, even virtually. To address that question, which could be resumed to can we get out of the scope conundrum? I hope we can, because that's the mother question. Because as long as we don't have an agreement on scope, it's very difficult to solve the other issues. Because everything is related to the scope, including the question on how much and how. So that's a very important question to solve out. And on that, I would say it's a very political question rather than a technical one, even if there are technical challenges associated with the scope. And notably because the broader the scope is, the more you face different technical challenges. So I say it's a political question where the response will be solved by governments themselves, and for the time being, the main question mark is on the US side with regard to that question, and that's where we hope that during the course of the next month, and rather sooner than later, if we want to be ready by June 2021, that will need to be solved, which means that we hope that the US position will move from what is currently, to my point of view, a collection of red lines, sometimes conflicting among themselves, to something which could be more seen as a concrete proposal, which would mean maybe to revisit some of those red lines. That's the hope we have in terms of trying to make that work progress in the good direction. As for my governments, like many governments, the issue is quite clear. I mean, we engage into that discussion in BEPS Action 1 several years ago, to solve a specific issue, which was related to the fact that we considered that for some business model, new business model, the highly digitalized one, the rules based currently on physical presence were not completely fitted because they were designed in the 20s to address those type of business. So we still consider that it should be in the scope, and that it should be addressed by this new tax international framework that we are looking after. Having said that, we have heard at some point of time that for some country, notably the US, the issue should be looked at on a broader scope. So we had shown a lot of flexibility on that, and like many countries, we agreed to look at a broader scope, and we agreed on the unified approach. So now the issue is to really refocus on what could be a feasible scope, acceptable scope for everyone, bearing in mind that we would not be completely desperate if that scope would be again refocused on what is the core issue for us, the digitalized economy. So I really think that here the the next month, if I should say the next week, will be critical because we really need some political agreement on that and some political leadership. Thank you.
Yes, thank you, Gail. And I guess you're hitting a key element of the discussion. And Barbara, who will speak to this in a moment, will correct me if I get it wrong. But I think in the last, I forgot, 6 to 12 months, it was either Treasury Secretary Mnuchin or someone in the Senate, I forgot, but there was a statement made that if Pillar 1 would focus on digital companies only, it is basically the rest of the world going after the United States and taxing the US digital players, with the citizens in the US picking up the bill. So that, I think, in a way, sort of exposes the tension here. So I wonder, Barbara, if you could talk about the US perspective on this. And in particular, we just heard, Gail, that the next few weeks may be very important, but we are hopefully in a transition period, hopefully, I say, with an orderly transition in mind in the US, that before the next administration would get its feet on the ground, will be well into new year, I guess. So on both, Barbara, the perspective and the prospect of progress, could you please enlighten us?
Sure. Thank you, Steph, and thank you for your comments, Gail. I think conundrum is a good word for the question of scope, particularly from the perspective of the U.S. government. And I think that the new administration, the incoming Biden administration, will be faced with exactly the same conundrum that that the current administration has faced. And I expect it will be a similar struggle. The focusing only on digital businesses does raise a lot of concerns, and has raised concerns in the U.S. for a long time. The position taken by this administration that you can't ring fence digital, that it's not appropriate to write special rules just for digital businesses, that it's neither appropriate nor really possible to define what or single out what is a digital business or a digital business activity. That position didn't originate in this administration. It was the position of the Treasury during the first BEPS project during the Obama administration, and it was continued in this administration. And I think also the concern that this administration has with respect to digital services taxes and the targeting of U.S. businesses is one that is certainly a bipartisan issue in the U.S. We've seen repeated correspondence and statements from members of Congress, the chairman and ranking members of both tax writing committees have communicated their concern and opposition to digital services taxes, and at the same time reflected the view that a multilateral solution, coordinated solution through the OECD process is a preferable approach, and so that is something that has been bipartisan from the beginning, and so I think would send a signal as to where the incoming administration would likely continue that perspective. The approach of expanding the scope of the project, the marketing intangible, inspired by the marketing intangible proposal to cover other types of businesses, addresses the concern about singling out digital companies. but it also has the effect of sweeping more U.S. businesses into the impact of the proposal, and I think that is really part of the conundrum. Frankly, putting in a threshold, which is an important part of this blueprint, using the CBC reporting threshold in order to focus the complexity and work involved in Amount A on the largest multinational businesses, also has the effect of increasing the percentage or proportion of U.S. headquartered businesses that are within scope. And so all of those things are things that this administration has grappled with, and are exactly the things that the incoming administration will grapple with. I would expect that. I guess my prediction is that the approach or the policy and the concerns are not likely to change dramatically. The concern about fairness and an appropriate treatment of U.S. businesses, the concern about the U.S. fisc, will continue in the new administration, and this will be a real this issue will continue to be a real challenge. I appreciate Gail's comments about needing guidance and perspective from the U.S. administration in the coming weeks, but I would caution that this will take some time. Inauguration Day is not until January 20th. The election won't be officially, the Electoral College doesn't officially cast their vote until December 14th. Then you've got the inauguration on the 20th of January, and then you begin the process of getting the cabinet officials in place, including the Treasury Secretary. All of that will take time. Certainly there is a tremendous amount of transition work going on already, including looking at the myriad policy issues that a new administration will have to deal with. And I'm confident that thinking about this has begun, but it will take some time, and appreciate that there is urgency about this. But I'm hopeful that the rest of the world will also appreciate that it will take some time for the new administration to be thoughtful about a really difficult topic.
Barbara, before we move over to Rasmi, let's be very optimistic here. So, say a couple of months down the road, we have agreements and also buy-in of the administration for Amount A. I guess there are still very big constitutional and political challenges for a mandatory system. Because that, I think, does entail a change in law, probably accession to a multilateral instrument to disarm Articles 5 and 7 of bilateral tax conventions. That's where probably the safe harbor, the Mnuchin safe harbor suggestion comes in. Could you just share with us a few thoughts quickly on the safe harbor, the background of the safe harbor suggestion?
Sure. I think it's important to go back to the text of Secretary Mnuchin's letter, which called out the fact that there were U.S. businesses that were very concerned about Amount A. And remember, the letter was written in December of last year, before the documents came out of the inclusive framework in January. So at that point, the only document was the Secretariat proposal for a unified approach, and there was a lot of uncertainty and concern. Secretary Mnuchin in his letter indicated that given that concern, it would be very difficult for Congress to legislate the changes that would be needed. And the changes that are needed really in all countries to reflect Amount A are pretty dramatic changes. They go to core aspects of domestic international tax law on sourcing and Nexus and double tax relief. And so those will continue to be challenges. I will say that since the letter was written, we've seen first the documents coming out of the inclusive framework last January, and more recently the very detailed blueprint that provides a lot more information and a lot more technical detail with respect to Amount A. But with that technical detail, naturally, it also raises additional questions, and so that the consultation process is valuable. Like, it will certainly be a challenge to in the U.S. as I suspect it is the case in other countries, to think about fundamental legislation like this in response to this process. In the U.S. With a divided government, very narrow margins in both the House and Senate, and in fact control of the Senate not yet determined until January, when the Georgia runoff elections take place. That will add to the complexity of trying to move significant tax reform legislation, and that's what would be required here.
Yeah, thanks very much, Barbara. I couldn't help of thinking of earlier this year. I asked one of my students to take Amount A and as a master thesis draft the template for legislation, and also draft an MLI that would disarm Articles 5 and 7 and other articles integrate with. And it was, the student did a wonderful job. So at some point I'll ask the student to send the master thesis to Pascal and his team in Paris, but it's a challenge. Let's move to Rasmi. Rasmi, India has been very present in the discussion. I think 2 years ago we had Akhilesh and Sol on the panel. What's India's perspective on the Scope Conundrum?
Thank you, Steph. Thank you for inviting me for this. And just clarify that the views expressed here are my own and do not necessarily present the views of Government of India. Now, coming to your question, I think we need to get out of the scope conundrum in any case. I don't think we have a choice. We have to agree on the scope. The scope as it stands in the report on the blueprints, the ADS and the CFP, in fact, it is informed by the fact that countries recognized way back in 2015 Action 1 report that the digital economy cannot be ring-fenced. Now, we subscribe to and continue to believe in that principle. But having said that, I think as Gail indicated, I think for us and for most of the members of the inclusive framework, the principal problem is due to the digitalized business models, where the existing Nexus rules anchored on physical presence become irrelevant, and the profit allocation rules based on ALP fail to deliver a fair result, in fact, sometimes a nil result in case of a remote presence. So broadly, all the digital businesses should be in scope. Now, if there is a situation and there is an of restricting that scope to some digital models, as some countries might have proposed or proposed earlier, I think that will not be a very sustainable solution in the long term. So for us, at least the digital businesses have to be in scope. Now, beyond that, whether it is CFP or the entire universe, I think both these arise from the US proposal of marketing intangibles and the safe harbor. We are fine with it from India's side, but I think as Barbara has said and Gail has said, ultimately, end of the day, it depends on the final position that the United States takes. And perhaps that is once the new administration is there and they take a final position, maybe we'll have a final view about the scope. Thank you.
Yeah, thanks very much, Rasmi. I'm sure we'll get back to that point later in the panel. So far, we have not heard the business perspective. So Liz, I think you're the only person on the panel who is responsible for the tax affairs of a sizable multinational that plays in this space. What's your take on all this, Liz?
Thanks so much, Steph. So first off, thanks so much for the comments of Gail, Barbara, and Rashmi, and for having me as a part of this panel. So I would say, a couple of things, right? So first, the blueprint is a tremendous output, right, from the OECD, and is significantly, and I would say even for somebody who's been practicing tax at quite a technical level, it is very, very technical, and clearly a lot of thought has been put into it. I would say, from a business perspective generally, that there is a keen interest in certainty, as well as elimination of double taxation, and to really sort of have a set of rules that's more principles-based than results-based. And so with that, on this question of sort of the scope conundrum, it would seem that very much the scope is very much focused on a snapshot of, at least on the ADS side, the landscape as it exists today. It seems very static. And I would also say that, in looking at some of the exemptions from the in-scope, from the sort of in-scope industries or businesses, some of the exemptions are very much based on, rationales such as, oh, well, it's a regulated industry, or, well, this is an industry that because of, licensing requirements or regulations or so forth, translates into a closer connection to a market jurisdiction. And I would, and I say that because I do think that looking at the ADS sort of categories of companies, or rather categories of sort of activities currently, based on the trend, right, of where sort of some of the discussions are happening on the regulatory side, right, separate from tax, but on the regulatory side, that it does seem that increasingly, I wouldn't be surprised if 5 or 10 years from now, many of those activities that are now listed in ADS are actually highly regulated, right? And we're already seeing that in certain jurisdictions. For example, already in certain jurisdictions, there's a requirement that certain types of digital businesses essentially locate consumer data in a local server, right, or local sort of computing equipment. And if that's not sort of a close connection to a market jurisdiction, I don't know what is, right? So I do think, rather than just sort of focusing on, well, it's these type of activities, which for me is very much a snapshot of today's landscape, I do think that it would behoove the inclusive framework to really think about, okay, well, if we're going to give, if amount A will exempt certain types of businesses based on the fact that it's regulated, or the fact that it requires a license, or the fact that some other local authority will be providing oversight, then what happens if one of those, say advertising, say platforms, say, cloud computing, what if any of those activities becomes highly regulated? What then? Do they become exempt from amount A? So I just think it's something to think about, which is to look beyond the current landscape.
I think you just added more complexity, Liz. So more challenges, but a very fair point, I would think.
May I come in on this, Steph, for a minute?
Yes, of course. Yeah.
I think, Liz, what we're looking at on that's my understanding of the regulation, is that it's not about industries getting regulated. All industries are regulated to some extent or the other. What we're looking at is an industry is regulated to a certain extent that the residual profit that it generates is generated and captured in the market in which it operates, like a region, like a retail banking, for example. So we are not talking that if an industry just regulated will be out of scope. What is the effect of the regulation? If that effect of the regulation is ensuring that the particular industry is generating and capturing the entire residual in that market where it is operating because of the regulation, then that profit need not be distributed. That's the why we have identified certain industries who fall into this category. Regulation per se doesn't exempt an industry. Thank you.
Yeah, Thank you, Rasmi. I think in the interest of time, and I recognize we started a bit later as well, so I don't think we have to stop precisely at 5 our time here. But on pillar 1, we just had 2 more questions, 2 more segments. One deals with simplification, and one deals with the prospect of multilateral agreement or unilateral measures. It's tempting to do both, but we have to speed up really. I wonder, Grace, could you spend just 1 or 2 minutes on simplification and really what this is about? Of course, everyone who went through the entire blueprint for Pillar 1 ended up with serious brain damage. So we have to work on simplification. But what exactly is the issue there?
Well, I wouldn't say it's any one issue, and I think Pascal already touched on it. I don't need to say too much. In developing this was a negotiated approach, and so there may be layers of complexity that we can remove as we work towards finalizing it. So, for example, one of the issues is segmentation, business line segmentation, regional segmentation. Different countries want different things based on, in part, on how multinationals keep their records, for example. So a lot of companies, we would like to have a rule that follows what companies do, but they don't all do it in the same way. And so some segment based on regional basis, others based on business lines. And so if we want to have accuracy in terms of determining what revenues are associated with the in-scope businesses, then you would have detailed business line segmentation rules, but that adds a level of complexity. So that's just one issue. We have the same types of issues of complexity when we're talking about eliminating double taxation. So overall, I think the idea is to just see if there are some ideas, and we hope to get more ideas through the consultation process on how we can simplify the overall approach, recognizing that you end up with rougher justice when you start simplifying.
Yeah, particularly on the second that you mentioned. I mean, I don't underestimate the segmentation issue, but it's also in the elimination of double taxation where the formulaic approach of amount A meets the arm's length principle, and where you're going to get the profits or trace the profit to, that then needs to be exempt in the surrendering country. Mindful of time, could I ask each of Liz, Barbara, Rasmi, and Gail to chip in really quickly and give their elevator pitch comment on what Grace just presented?
Sure, thanks, Steph. So I'll be brief since we're short on time. So I would say that, for this question around simplification, business line segmentation, and so forth, I do think, to go back to the theme of certainty, that, rather than having a rebuttable presumption, which is something that, sort of the, is what has been sort of put forth largely in the blueprint, to make essentially audited financial statements, right? So whether it's under IFRS or whatever the local accounting standard is, to essentially make audited financial statements serve as and the segmentation that's in those audited financials serve as a type of safe harbor for business. So this way they're, again, it can serve to provide more certainty that sort of as long as the attest auditor signs off, that's a taxpayer can rely on that.
Yep. Barbara?
Well, I'll make a quick comment about elimination of double taxation, which is really critically important here. And I think I agree with Pascal that simplification, when it leads to very rough justice, is really not the direction that we need to go. And on elimination of double taxation, while I appreciate that the deference that the blueprint shows to domestic law and basically indicating that you look to domestic law rules for eliminating double taxation, it feels like the nature of Amount A is that it really should be 100% exemption, that anything short of that would not be full elimination of double taxation, and that it really calls out for having special double tax relief rules. So a deviation from a country's credit system, if they have a credit system, because of the limitations of that credit system, a deviation from a 95% exemption where countries have that, that really you need full exemption given the nature of Amount A being a portion of a mix of consolidated profits. And so I think that would provide greater certainty and in the end be a real simplification.
So very straightforward, no credit, no choice between credit and exemption, just exemption. Yeah. Rasmi, please.
Yeah, thank you, Steph. I think I'll be also brief. The segmentation also depends on the scope. If the scope is very narrow, you need to have more segmentation. If it is broad, if it's the entire universe, perhaps you don't need segmentation to some extent. Having said that, I think as Gail said, and as I think Grace also, as Grace said, we can have a system of, let us say, safe harbor up to a certain level of revenue, and then thereafter we can rely on the business disclosed segments in the financial accounts, subject to certain anti-abuse rules to prevent gaming. On double taxation, I think the problem is not that acute in case of ADS and centralized business models, because I think there it's easier to find out the entities which hold residual profits, so you can identify the living entities. The problem is a little complex in CFB, which are not that centralized business models. But I think there perhaps a simplification measure, distribution, marketing safe harbor may work. That's what we're working on. Thank you.
Thanks, Rasmi. Gail, when I turn to you, I just pick up on something that Rasmi mentioned. Of course, there are extremes. You either have an extremely narrow scope or you bring in everything, and conceptually, in both cases, things become simpler. Gail, you just mentioned that as far as France is concerned, I think I understood this correctly, it's a narrow scope and focuses mostly on digital, but France is also a member of the European Union, and it seems that the European Commission is ready to dust off the CCCTB, the Common Consolidated Corporate Tax Base, which of course would be all the way to the other side. So in that context, Gail, or outside that context, what would your remarks be?
Well, with regard to CCTB, I think that things are complex enough to reach an agreement at the OECD level, not to mix that with the CCTB issue, which is another complex issue.
Yes.
So that will be my answer on that point. With regard to complexity, I think the way to try to have less complexity would also to be clear on scope. I never said that we would prefer a narrow scope. I just said that if a narrow scope brings more simplicity, which I believe, then let's do it. Because we can see that a broad scope brings some technical and political difficulties as well. With regard to segmentation and profit allocation, I would simply agree with what Rasmi has said. We are on the same page. Bearing in mind that for elimination of double taxation, that's not just a technical issue, because we have a zero-sum game. And this is part of the profit allocation as well, because it means where the money comes from. So that's not only a simplification issue. At some point, it has to be also accurate in terms of who is going to pay for the financing of Amount A. So it's a little bit more tricky than on segmentation, where I see a lot of room to improve the project and to bring simplification with safe harbor and relying on disclosed segment where it is relevant.
Thank you, Gail. And that's actually a good segue into briefly addressing the third question here, and that is what's next, the prospect of a multilateral agreement or unilateral measures. And by way of introduction of that, if we look at all the complexity of Pillar 1, if we think of what Pascal said in the very beginning, that we're talking about still a significant revenue shift from one country to another, but in the overall scheme of things, also given the size, frankly, of the corporate income tax as a percentage of revenue in many countries, which is below 10%, one could ask the question, why are we doing all this? And why are we using all the resources, the bright minds to do this project? But of course, the project addresses the prospect of a system that, in the eyes of many, is broken, does not address the digitalized economy. And if we don't solve this, we may end up with chaos. So, Gail, maybe I stick with you and ask the question, what is next? Do we have a real prospect of a multilateral agreement, or do we face unilateral measures?
I hope so. I mean, I hope we will have a multilateral agreement. For everyone, that's the first best. That's the first best. The question of revenue you raised and much ado about nothing is reasonable, but we shouldn't only base ourselves on assessment made on 2017 revenue data. I mean, we are facing a new type of economy which is growing. And I think and we are building something not just for the 2, 3, or 4 years to come, but something which will be made to last, I hope. And that's why it's very important to build something which is sustainable, which is permanent, and where we can avoid the counterfactual, which is that naturally, if there is no solution, countries will be tempted, because that's the way they are, to find a solution by themselves. But frankly, I think the best solution would be to have an international framework which is sustainable. And it is not because today we would not collect as much revenue as expected, or as we would collect under unilateral measures, that it's not a win-win situation. Because again, that's an increasing sector which is developing very fast, and that's also a bet on the future, I think.
Thank you, Gail. And given the fact that what you just said is extremely difficult to disagree with, I would ask Rasmi and Barbara and Liz to only speak to this segment if they feel it's really adding to what Gail said, and otherwise, if you allow us, we would move to Pillar 2 because time is moving on. So I just pause here for a sec to see whether Rasmi or Barbara or Liz feel an urge
just
to chip in. Yeah,
I will take 1 second. I think your question contains a message which is loud and clear. Either we'll have a multilateral solution or we'll have unilateral measures, which means the status quo is not going to continue. I think that's the reason as to why we need to have a multilateral solution, and it must be a little bit more than suboptimal, because if it is suboptimal, then the solution will be there, multilateral solution as well as unilateral solution, and we'll have the chaos will be much more.
Yeah.
Thank you.
That's incredibly important, isn't it? I hear Barbara. Yeah.
And I have just one quick comment. I completely agree with the prior comments. A multilateral solution is so important, and it needs to be one that is sustainable, that is fit for today and also fit for 5 or 10 years from now. And with that, it seems to me one thing that could be done in this project now, in this period, is to take all of the detail work that's been done in the blueprint and step back and try to translate that into principles, go back and test the details against the original principles, and maybe adjust some of those principles. I think that would make the rules more sustainable. It would address some of the concerns that Liz raised about changing business models if there were underlying principles that supported the details. But I also think that looking at those principles and developing those would be a path toward trying to solve the scope conundrum.
Yeah, very important addition as well. Liz, just in case.
Sure, I just have a very brief comment. So I would also say, just in terms of, hearing Gail's comment, right, around building something that's robust for the future, I do also think that, currently the assumptions of digital and sort of remote selling and so forth, a lot of that is changing. And a lot of that has been accelerated because of how COVID has made remote working more and more the norm, right? And so as a result, you're going to see centers of creators, right? Centers of technical creation shift out from the traditional sort of export, sort of residence countries into places that I think people would be surprised, hearing about today. Just looking at a list of, top places for software engineers, Kenya was on the list, as well as Indonesia and a whole host of many developing countries. So I think, it's something to keep in mind, right? That essentially, people are now hammering on ADS and US, largely US tech companies because of models from a decade ago. And again, if we're to build something that lasts, we need to sort of take into account these trends.
Yep, absolutely. With that, I think we ought to move to pillar 2. Yeah, I'm almost inclined to apologize to you, Achim, because it's the same as last year in London. We spend a lot of time on pillar 1, and then we get to pillar 2, but we do have time. And the other thing is that each time, Achim, when I hear you talk about pillar 2, it sounds all so simple that we probably don't need as much time as for pillar 1. So with that, Achim, would you kick off on pillar 2, please?
I'm trying to. I hope you can see me. So if you nod, can you hear me?
Yes, absolutely. Yeah,
that's a good start. You also see I fully color coordinated, so I'm dressed just like you. Glasses are different to make this even easier. So it could be Steph or it could be me. I think that's 5 minutes on pillar 2. I think that's all we got so that we have time for the discussion. To slow down just a little bit, because otherwise I can't even follow what I say myself. I think there is the big political question and the political environment. Where does this pillar come from? A global minimum tax? How does this fit into the digitalization process? What's the backdrop in terms of BEPS? Unhappiness, if you wish, with where we ended up in BEPS and certain actions, whether that's maybe action 3 on CFC and then you see guilty coming out, whether that's action 5 on harmful tax practices, and we seem to have ended in a result where we see more and more IP regimes, patent boxes of the like, rather than putting a box around the box, we seem to have multiplied the boxes. And then 8 to 10, I can spend a long time on, what's the origin, where does this come from, what's the policy environment, which is, if you step back and you look at 137 jurisdictions, is not one rationale, and sometimes in academia, people struggle with the notion that there isn't a person that comes up with the rationale, but that there is a confluence of different views and trends and streams amongst 137, out of which emerges on a consensus, on a direction out of which crystallizes the discussion around this topic. And this topic, of course, on a minimum tax, on not purely substance-based, these elements have been with us for a long, long time. And you see it in action 3 and earlier work, and you see it continuing in guilty, and you see it in the action 5 and 8 to 10 and in all of these approaches. So that is what I will not talk about because we don't have the time, but I'm just putting it out. There's a very important dimension here. I'm going to focus purely maybe on some technical aspects, I think, that are important also for the audience here. And then I'm trying to say in my 10 minutes. So I only have 4 slides. They're all pretty pictures. Hopefully that's pretty. That's the first one. That just gives you an overview. Most of you know what pillar 2 is, sometimes referred to as the global minimum tax. Maybe that's accurate, maybe not. Residual BEPS issues, there's different ways of approaching it, but it essentially has, if you wish, 2 building blocks. So there's a building block with an income inclusion rule and an undertax payment rule. And conceptually, you can think of the undertax payment rule almost like a reverse CFC rule. The income inclusion rule is effectively a CFC rule of a different type, admittedly, built or derived from earlier work in action 3, but also the US guilty. And then there is a reversal that sort of applies the undertax payment rule where the income inclusion rule does not apply. I think if you look at the first block here, which we call the global rules, take them together, then you see that there's a base. It has scope, it has the calculation of the jurisdictional ETR, there's carry forward rules, there's carve out rules, there's a simplification chapter, and that's what we're going to focus in. Many of these aspects are relatively stable in the technical discussion, and what you see in the blueprint is largely where the discussions are. There is a number of aspects that we have highlighted in the blueprint where we're seeking input, in particular through the public consultation, but also more generally, there is ongoing work in those specific areas that are identified in the blueprint. I'm going to come to them in a couple of minutes just to give you a sense of what they are, and then also hopefully that on the technical side could be a focus of the input that hopefully we'll be receiving. I think you then see these sort of chapter 6 and chapter 7 on the bottom, where essentially we say, well, there's a common base calculation that underpins both the income inclusion rule, which then leads to an attribution at the level of the shareholders, traditional CFC technology, or it's an allocation with 2 allocation keys where the rule does not apply. So this is, I think, something on the first block. And the first block, I think, is, if you wish, a sort of a systemic attempt, not so much about who gets the money. So this isn't so much about an allocation of taxing right, as is sometimes claimed. This is creating a system where you ensure that the system ensures, through its cooperation and the interdependence of these rules, that there is a minimum level of tax with appropriate carve out for substance, etc. So it ensures that sort of systemically by having these interlocking rules. And then there's another block, the subject to tax, and I think we're going to talk about this if we have time in a little bit. The subject to tax is a slightly different conception. It's more like a bilateral treaty aspect. It's looking at a particular country that cedes a taxing right in connection with a treaty on the assumption that on the other side, the recipient would be taxed at a certain level of tax. And when this is not the case, then that first contracting state, as we always call them, would like to get that taxing right back without having to terminate the treaty. So it's a much more bilateral dimension that complements or supplements, as you wish, the basic infrastructure rules around the undertax payment rule and the income inclusion rule. And then as you see, sort of there's a block in the middle and a block at the end. So just 2 words on these 2 blocks here. So we've talked about the globe rules, income inclusion rule, undertax payment rule. We've talked a little bit about the subject to tax rule and how they talk. And then there's some special rules, which we are exploring. So these special rules as to whether they will happen, will the pillar happen, and within that pillar, will these rules come to fruition? These are special rules that deal with questions essentially outside the consolidation. There may be particular base stripping payments that are being made to an entity under common control, but that is not in the consolidated group. And there may be pieces that are not in the consolidated income because you have a joint venture. And what do you do in these situations? There's a couple of options. You do nothing, you do something. And if you do something, what is it that you do? Do you try to do something perfect, or do you try to do something simpler? And these are the balances between accuracy, where you want to go, and how much of this territory you want to cover. And then very importantly, there is the rule coordination, I think, which is not yet there. You're too fast for the slides, faster than even me. So the last bit here, like the rule order, very important dimension, so that we're not going from 0 taxation to double taxation. So there needs to be a rule order so that these rules apply in a coordinated fashion, both inside the rule, if there are several income inclusion rules through a multi-tier chain, where do you start it, but also across the rules, income inclusion rule versus undertax payment rule. The treaty compatibility question, do you need a multilateral convention? You want a multilateral convention? What are some of the aspects? I think we write quite extensively in the blueprint about that. Coordination I've mentioned. And then also, how can you get to a dispute prevention so that you also, not just in theory, but all in practice, have a coordinated system where we don't have a duplication of the application of the rules. So now I actually do go to the next slide and try to focus just a little bit what delegates were thinking in developing the rule. And then the last slide, so there's only 3. The last slide talks a little about, highlights the type of issues. And again, I'm focusing much on the technical side now, where specific input is requested and where the discussions are at the technical level. So first, what's already in the design? I mean, first, on a number of these questions, the delegate in Working Party 10, and I think we have Marco with us as the chair, did think about at each point of the design, are there things that we're seeking to achieve from a policy perspective that we can achieve, but by doing that in a way that would be simpler? So that's a question on scope, a revenue threshold, seeing that it is clear that the direction is that small and medium enterprises will not be affected. And then also looking at the consolidation, looking at the group, having excluded entities, specifically funds and a couple of other financial services that can talk about it. The base, using the parent financial accounting standard with basically no book-to-book adjustments, also to make it easier, and a very limited number of book-to-tax adjustments. Simplification when we use the reliance on entity-level financial information, and also simplifications in the mechanism to address timing differences and volatility. I'm going quickly to the next slide. So you see it's a continuation. If we go to the next slide, you see the other features. We try to leverage off CBC reporting. In the rule design, most of the rules you see from a design perspective, they take a bright line and not facts and circumstances. So we've taken a page out of more formulaic approaches rather than sort of traditional transfer pricing, facts and circumstances approaches. Clear rule order and coordination, top down, something where it's easier, priority rules for the easier rule to apply first, for instance, the income inclusion rule. Subject to tax, the discussion centers around a nominal rate test and a limited category of largely intergroup payments that give rise to BEPS. And then on the last slide, recognizing the time so we can get to the discussion, just giving you a bit of a flavor. These are the lists of the things I think that are now particularly highlighted on the technical side. Treatment of investment funds, tax transparent entities, we get this right. Treatment of dividends and gains from the disposition of stock in a corporation. Reorgs, if there's a tax exempt reorg that maybe from an accounting perspective would look different, how do we get them out when we don't want to get them in? Addressing the timing differences, I think we're all clear that you shouldn't go into the minimum tax just because there's timing differences. There's a time value of money component, you would have to reverse it out, but we don't want to take this in the first place. They need to be pre-globe losses. And then there's a big chapter, and maybe I finish with this in the report itself on simplifications. I'm not going to take you through all these simplifications, they're in the blueprint. Whether you leverage off CBC reporting, because that's what the groups above 750 already do, whether you have guidance on tax administration. The idea essentially is to come up with a system. So if you're a large company and you know that maybe you're only within the ballpark of the min rate, if you look at the base and you look at the min rate once it's agreed, that may only be a small cohort of jurisdictions where you are potentially affected, that we don't force you to do the calculation everywhere at great cost, only in order to find out what we already knew, which was, well, in this country, I'm very unlikely to ever be any close. So how can we have intelligently reducing the compliance cost while retaining the tax policy objective of the measure? I think there everybody's extremely open. We as government representative have identified a number of options. There may be many others. And so there's a great openness to find the most intelligent way of moving forward on the technical side. I think maybe I leave it with that in the time that we have.
Yeah, thanks very much, Achim. I just heard from Cecile at the Secretariat that we could go on until 15 minutes after the hour, so we have some time for the discussion. Of course, there is no way to for me to keep the audience to the screen in a big room in a Congress center. Of course, you're captive mostly, but you're not behind the screen. And I hope that our speakers have some time after the hour, say 15 more minutes as well. I thought that, Barbara, if you don't mind, you're listed here as the first speaker, but we have not heard from Martin and Marco and Mike. So if you could switch or trade places with them, I'd ask Martin maybe first to comment on Pillar 2, not just on the complexity, but probably also on the political challenges with, I don't know, Martin, both your CFA and your German hat on, whichever one you prefer, or just your own hat.
Thank you very much, Steve, and hello to everybody. So yeah, let me maybe start with the tax policy objective of Pillar 2, and I'm grateful to Achim that he already touched on that question, because I think before we talk about proportionate compliance efforts and administration efforts, I think it's really useful to look at the tax policy rationale behind Pillar 2, which is to create a worldwide level playing field when it comes to ensuring a minimum amount of taxation. And A second point I would like to make in that context is is on implementation. So what do we expect from this discussion? We are 137 member states in the inclusive framework. Do we expect everybody to implement Pillar 2 as a minimum standard? Do we expect zero tax jurisdictions? We have a number of zero tax jurisdictions on board in the inclusive framework. Do we expect them to implement Pillar 2? And what would that mean if they implemented the minimum taxation idea? So the realistic political expectation would be here that we, in the end, hopefully agree on a package consisting of Pillar 1 and Pillar 2 that seems to be more or less common sense. But then when it comes to Pillar 2, unlike with Pillar 1, where everybody needs to implement, otherwise it wouldn't work, when it comes to Pillar 2, we would create a level playing field, a worldwide level playing field, if we would get, by and large, let's say, 90% or 95% of the world economy, if they would implement Pillar 2, the system as such would work. I'm saying this because I participated in a discussion last week with business here in Germany, and they came up with the idea just to drop the under-tax payment rule. And they said, okay, if you get everybody on board implementing the income inclusion rule, then you don't need the under-tax payment rule. And this is politically it's not a realistic scenario. So what we need, if you look at the tax policy objective, we need the full set of the GLOBE rules. We do need the income inclusion, the switchover, we do need the under-tax payment rule, and of course politically it's also, I think, more or less accepted that we talk about the subject to tax rule. So we need this full set of rules. When it then comes to the question of administration and compliance burden, I think that is an important point that has played a big role in the discussions we had in the inclusive framework, and in particular in the steering group. And here I think consistent implementation, that is really key when we look at Pillar 2. What we also need, I think, is more coordination among tax administrations. We also need to set up a system that builds trust that the effective tax rate is being calculated on the right basis, so that everybody would accept that this is the effective tax rate. That is also an important feature, I think. And that's it for the moment from my side. Thank you.
Yeah, thanks very much, Martin, also for making the key point that if not everyone is on board, you need the under-tax payment rules as a backstop. Otherwise, you will be confronted with the outliers, and the project may not reach its purpose, I guess. So moving to Marco. Marco, we did not have the benefit of the prep session because you stepped in last moment, but you have been very much involved in this theme. Perhaps if I would ask you to comment also with the EU, European Union specifically in mind, and what type of coordination, maybe in the form of a directive, we could expect in the EU relative to Pillar 2, Marco.
Yes, thank you very much. And also on my side, I think that I agree with most of the things that Martin has said on the policy rationale of this. On this Pillar 2, because the globalization has brought the possibilities of tax optimization, and of course in this discussion the BEPS has trying to address the problem, but of course the level of rate is an important issue that complete the framework, and from our perspective, from my country perspective, it is certainly needed. I think also I agree with Martin that the issue and the objective is to ensure a level playing field at the global level for to ensure not only the stability of the system and also the efficient decision of multinationals when they invest across border, but also the sustainability of public finance, which is an issue that was there at the beginning of the BEP project, but it is now even more relevant with the crisis, with the need to ensure resources to the state for the recovery in short term and to the consolidation of public finance in long term. I think that the attempt in the formulation of the different rules and the coordination of the different rule component of the Pillar 2 is to achieve a consistent approach that can be followed and implemented at global level. Of course, this is an important element also from my perspective, and the consistent implementation will ensure also the simplification of the tax certainty for the enterprises. Of course, you rightly mentioned about the European Union. I guess that if we implement in Europe the Pillar 2, this should be done, in my perspective, with a directive, as we did, for example, for some of the BEPS actions that has been implemented to the other directives, because the directive will ensure consistent implementation within the EU. In addition to that, also the control of the European Court of Justice, and this will be, of course, the guarantee that the rule will work in a proper way. I think that to conclude very briefly on the key features of the Pillar 2, I agree also with Martin that some of the simplification design element, like the reliance on consolidation, the fiscal financial statement, the reliance on the country-by-country reporting to the extent possible, also as safe harbor simplification, and the importance of the coordination and implementation, also through cooperation with tax administration, will be very important element of the Pillar 2. For the consistent implementation of Pillar 2.
Thank you very much, Marco, and that is in fact a good segue to Mike, who has been listening diligently, I guess, all along. Mike, an EU directive certainly will not cover your jurisdiction, and perhaps you could suppress your enthusiasm for Pillar 2. But at the same time, recognize that the world, if there will be consensus, may end up with a package of Pillar 1 and Pillar 2, which goes to something that I think that I know is of great concern to you, and that is the sustainability of the system and avoiding the counterfactual. So with that remark, if you're still on the panel, Mike, would you share with us your perspectives on this?
Thank you, Steph, and good day to everyone. I am still on the panel. Indeed, to prove I've been listening diligently, can I just say that I very much agree with Barbara that the answer to relieving double taxation under Pillar 1, Amount A of Pillar 1, is exemption. I don't think that the alternatives really work. We're talking about moving around where the profits should be taxed, not somehow coping with the profits being taxed in loads of different places, which I just don't think is feasible. In terms of coherence, it seems to me that we'd only get consensus if we have both Pillar 1 and Pillar 2. And that's because some countries are more interested in Pillar 1, I think everybody knows includes the UK. Some are more interested in Pillar 2, and some are interested in both. And I think realistically, this proposition that we do one and then come along a lot later to do the other, well, fine, but I don't think we would ever do that. So I do think we need to stick with the proposition that the pillars are intertwined and bolted together. In terms of Pillar 2, I mean, I think a key thing that we need to sort out is the interaction between Pillar 2 and its GLOBE proposal, which will apply to the rest of the world, and the US's GILTI rules. I think that includes, of course, what an equivalent rate might be, which in any event isn't an easy concept, given that the Pillar 2 rules operate on a jurisdiction by jurisdiction basis, while the GILTI involves global blending, or largely involves global blending. I think that's clearly one aspect, and there is no firm by firm way of doing that, obviously, because they're different rules. So you can only deal with that, I think, in the aggregate. But I think it's not just about coexistence, it's also about interaction. Let me give just one example where, say, there's a US subgroup of a UK-based group. So you have the UK applying the income inclusion rule to the group as a whole. You've got the US applying the guilty rules to the subgroup in the US. So you've got both sets of rules applying at the same time. You've then got three choices. You either allow double taxation to exist, which is clearly a choice that we don't normally adopt, or the US alters the guilty rules to lift the charge on the US subgroup, because the UK will be charging the IIR onto the parent company. Or third possibility is the UK would give relief to the parent company for the guilty tax in making the income inclusion rule charge. It's not obvious, I have to say, why the UK should do that, given the logic of Pillar 2. But let's suppose, just in terms of a thought experiment, the UK did do that. How mechanically would we do it? Given, as I just said, Pillar 2 operates on a jurisdiction by jurisdiction basis, but the guilty operates globally. So the UK, in applying the income inclusion rule, would need to know where the guilty tax attached, which jurisdiction did it relate to. But of course, the nature of the guilty entity is global, so it doesn't have rules within it that we can look into to see that. So I think that raises a complex issue that if we are going to have the guilty rules coexist with the globe rules, we are going to have to sort out. I think, finally, another important issue for us to sort out is whether the Pillar 2 globe proposal should be reflected in treaties or not. I think we, on the whole, favour building at least some of the core features into treaties. Why? I think three reasons. First, I think you get greater clarity over the commitments that countries have made to one another, and equally greater ability of businesses to challenge where those commitments are not met. The treaties give taxpayers rights as well as regulating the relationship between countries. I think second, the need for coordination of the interactions between a number of rules, each of which are, I think, necessarily fairly complex. And finally, it seems to me a bit odd otherwise. Pillar 1's proposition, as Grace mentioned, is to encourage countries to eschew or avoid or pull back unilateral measures such as digital services taxes. And there's clearly a quite good justification for saying that we needed that coordinated approach. But then my worry is with Pillar 2, are we in effect saying that countries can do what they like, so long as they build on the globe or their CFC rules and keep things clear of their tax treaties by charging the profits onto the shareholder rather than to the entity making the profits? It seems to me that would be a bit odd, that we would in effect be denying unilateral measures under Pillar 1 whilst opening up a new prospect of unilateral measures under Pillar 2. So I think we need to think through that quite carefully, because of course, if you are going to reflect Pillar 2 in a treaty, you have to think carefully how you would do that as well. Thank you.
So what you think, Mike, and we did not talk about this, but that you then combine the Pillar 1 and the Pillar 2 elements in one new multilateral instrument?
Well, I think if we were only looking at Pillar 2 in isolation, then I think the proposition that you do an instrument for Pillar 2 alone, I can see why countries object to that, Steph. But on the other hand, I think we're clear, certainly we in the UK are clear, that you have to do Pillar 1 and Pillar 2. If you're already faced with needing a multilateral instrument for Pillar 1, then I think recognising that you will then build into that some elements in relation to Pillar 2 is, I think, more straightforward. And obviously, as long as you do it at the same time, it doesn't then delay the time to ratification. And I think it does solve some of the difficulties with how the bits interact and the need for the countries to work closely together as well.
Yeah, that makes sense to me at least. Thanks, Mike. Let's then move to Barbara. Barbara, guilty was mentioned a few times already. I guess in the perception of some, the US moving forward with guilty was the genie out of the bottle and opened the way for Pillar 2 in the OECD Inclusive Framework project. So you have lived through guilty and the regulations over the last couple of years. So maybe on two things. What's your takeaway for the audience, and how do you see guilty and Pillar 2 live next to each other with, let me call it, grandfathering. I guess is a bit of a misnomer, but having them side by side, Barbara.
Well, thank you. I have said in the past that I don't believe that guilty is the U.S.'s best export. But we are where we are, and the rest of the world is looking at Pillar 2 minimum taxes, and the issue of how guilty coordinates is an important one. Here there could be we could see some change in the new administration, in the sense that President-elect Biden's campaign tax plan included proposals to change the guilty rules, including making changes that would have the effect of moving the guilty rules in the direction of the design that the OECD is looking at, moving to a more country-by-country approach. Now that would require legislation, and as we talked about in the past, there are challenges for big reform legislation in the U.S., particularly in the short term, with potentially a divided Congress and at a minimum very close margins in Congress, but it is an interesting direction when you think about the alignment between guilty and Pillar 2, and one that will get a lot of attention, and certainly those proposals for changing guilty are raising a lot of concerns among the U.S. business community, but something to watch closely. I think in terms of the issue of coordination, there also is a concern about how guilty coordinates not just with the GLOBE rules, but the subject to tax rule. That would raise significant issues if there isn't a coordination there, and at least the way the blueprint is written, it refers to special rules for guilty with respect to GLOBE, and doesn't go beyond that to cover the subject to tax rules. And I think there are a lot of questions that are raised by the subject to tax rules. And I think that is a direction that to me is a surprising direction for the OECD to be putting the reliance on a gross basis withholding tax as potentially the first priority among these this rule coordination. It is such a blunt instrument, and one that the OECD, I think, has a long history of seeking to reduce gross basis withholding taxes through treaties wherever possible. I also think that the issue, I think there were some very good comments made about the issue of trying to coordinate between guilty and its current global blending state and the measurement of a Pillar 2 income inclusion rule or under tax payment rule. I think there are equally or even more difficult issues to try to coordinate between a subject to tax rule that is a gross basis tax that isn't based on an ETR. How do you coordinate that with a top-up minimum tax that's a net income tax? Just how do you align those rates in a way that makes any sense when the level of expenses for any given payment could be very different? I think those are significant challenges going forward.
Yeah, thanks very much, Barbara. I think we're getting close to the real stop of our seminar right now. But before we go there, I invite any of the members of the panel, if there is anything that you really wish to convey to the audience, and if you can do that in a really crisp remark, you're invited to do so. So I will keep silent for a little moment, with the slight risk that I create more chaos than would occur without Pillars 1 and Pillars 2 materializing next year.
If I may start, and I promise to be very brief in my comment. Just want to say that there is benefit for all member states in the inclusive framework if we manage to implement Pillar 2 in a coordinated and consistent manner, and that would be my first priority. And I think that is extremely important. And maybe just a brief comment on Barbara's point on the subject to tax rules. I think we also need to be aware we are more than 100 countries, 137 countries. Most of them are developing countries and they have their specific interests, they have their limitations in administrations and so on, all the arguments everybody of us knows. I think that resulted or results in a discussion about those rule order questions. And you are fully right. We need to make sure that we keep consistency in the whole system. That is an important point. Thanks.
Thank you, Martin.
Very briefly, I mean, I think we need to sort out whether the minimum rate is also a maximum rate. You know, I think we broadly agreed that we will top up to an effective rate and not go beyond that, Steph. But what's then the enforcement mechanism for that? In other words, what's to stop a country seeing the minimum floor rate as a floor rather than also as maximum rate, on which it then sort of builds higher, to sort of use an architectural analogy. Equally, if we want the rate to be both a floor and a ceiling, so the minimum rate is also a maximum rate, at least under this proposal, how would you go about reflecting that in the treaty provision, given the acceptance of CFC rules that exist outside treaties? So I think that's a difficult conundrum, but of course it affects the political judgment on what is an acceptable rate. If you believe that the minimum rate is also a maximum rate, then it seems to me you might be prepared as a finance minister to agree to a higher number than if you believe all you're doing is setting the floor from which at least some other countries would seek to advance. So I think that, to me, is another thing that we are going to have to sort out.
Yes, thank you, Mike. And in passing, you responded to one of the questions that was raised from the audience as to the maximum rate. So thanks for that. I think I saw Achim raising his hand. I'm not sure.
Yes, I did. I mean, just a quick one, you know, in picking up Mike's point also earlier about sort of the unilateral measures and the dimension in Pillar 1, the dimension in Pillar 2, sort of just reporting on a recent conversation with, I think, the head of tax of a large pharma company that in some sense put out this alternative scenario. So like, I'm not a fan of Pillar 2, but the worst would be if Pillar 2 failed, because we might end up with a lot of Pillar 2s. And so it's also the counterfactual of what would happen. I would think that probably that minimum tax also, given the fiscal needs of many countries, this is a topic that, given the current situation, isn't going to go away. And so we also need to think about how we steer through this environment.
Yep, thanks.
If I may, Steph, coming in. So, and so I have to do it very quickly because I have a call starting in 1 minute exactly with colleagues from the IMF. Don't want to be late to that one.
I was already amazed that you were silent for an hour and a half, Pascal.
And precisely, I wanted to react what I heard. I think there is a serious paradox or contradiction here. Everybody says we need to have a solution, we must have consensus. And from what I hear from business in particular, but also sometimes from the delegates is, but we have big differences and we don't intend to resolve them. And I haven't heard anything from business being really a positive contribution to how we find the solution. Very good at listing the problems, much less good at finding elements to find the solution, which is a bit in contradiction with we need a solution. At some point, you know, it's crunch time. We'll have to have constructive inputs so that we can reach a solution, or we'll fail. And we'll fail. If we fail, good luck to everybody, starting with us, which may have a pretty negative impact. Everybody recognizes that, but it looks like you recognize that, but you act differently and you don't really try to bridge the gap, and that's a bit worrying. Now, I saw in the chat a question, well, if you fail, why don't you pay attention to 12B of the UN? I said, that's cute, a cute question, if I may, but it's only cute because if you look at the effort of 12B, I mean, we would have probably been smarter at the OECD to come up with 3 pages to say this is our wishful thinking, and 3 pages look very simple, and why isn't it the basis for a solution? I mean, this is not really serious. I mean, if you want to move ahead, you need to deploy what a solution would mean in practice. It's not enough to say, oh, countries will change their tax treaties. They will not, unless they agree. And that's where you need to do the effort. Can they agree? Now, if you start with the assumption they will not agree, indeed, you can do whatever you want. And by the way, you should do work which at least would work and would work effectively and efficiently for the countries which would agree something. I think what's ahead of us is probably, I mean, 3 different options. One is no agreement, gross-based DSTs, good luck for business, because it will not be limited to digital in the midterm. We'll see. 2 is agreement that, after all, it's very difficult. The money which would have to shift would not be big enough to do a comprehensive reform. Comprehensive reform have too many losers to agree it, and therefore you limit the solution to what is the dispute. That's highly digitalized business models. That's a bit of a frustration, because I think we all agree in the back of our mind that the international system is not fit for purpose, but you know, you deal with the urgency, digital stuff, and you move later on consumer-facing business or others, and you move to a net-based DST. I use that expression. What does that mean? It means that you tax profit, and if you have to tax profit, net-based DST or net-based taxation of a limited number of companies, then if you do that, you need to change tax treaties, you need to change transfer pricing rules, you need a global agreement, and not a statement that, oh, we should do that to tax treaties without having, I mean, the real stuff behind that. The third option, which would be our favorite option, is a comprehensive agreement, which is incremental. That's a start, but it's comprehensive because it stabilizes the system. We, I think, all agree that the arm's length principle, after all, for routine transactions is not that bad. It's working for most of the transactions. It's failing on the hard to value intangible, on intangible property in general. That's only probably 20% of the transactions, probably 80% of the value. And that's where we need to do better than the current situation, which is unstable, which is uncertain. And if we move there, well, then I think we have a good basis, because the members have done a tremendous work in exploring Pillar 1, and I've just limited my comments to Pillar 1. Pillar 2 is a different animal with its own logic. You can see the political link. Mike was eloquent making the political link with Pillar 1, but it's a different animal. And by the way, an animal which could live its own life without full consensus, with the risk that Arim highlighted if there is no full consensus. And on that note, I realized that I'm 4 minutes late to my colleagues, with my colleagues of the IMF. So I rush, and thank you all. Congratulations for the chairing of the panel, and for all the panelists. Thanks a lot. Looking forward to seeing you in person next year at the IFA conference.
Thanks very much, Pascal. And with that, I think we have come to the end of our seminar. What I think was a very rich seminar. Of course, impossible to cover all these topics in the time we have, but the core of the message is very clear. It's imperative that we reach a solution, and that everyone is engaged, even though we may not like the disruption and the complexity, but the alternative is not very attractive. With that, I would sincerely thank the panel for the, as I said, the rich discussion. I truly hope, as Pascal said as well, that our next meeting, our next IFA meeting, will be in person. I also thank a lot the audience that stayed tuned in for the whole of the seminar. The IFA Secretariat also tasked me with bringing to your attention tomorrow's program. At noon Central European Time, there is the combined meeting of the General Assembly and the General Council. Very important to be there. And then at 3 p.m. Central European Time, there is the recent developments in international taxation seminar chaired by Chloe Burnett. And as you will recall from the past years, that is always a very exciting seminar as well. With that, I close. And again, thanks a million to the panel and to the audience.